Happy Wednesday, everyone. Welcome back to another edition of #AskRobCo. Hope you're all well, safe, had some good holidays, are enjoying the Indian summer. What a week of weather we are seeing. London is looking beautiful today. For those of you that are following on all the other platforms, you would have seen some great shots and photos of the beautiful skyline that we have here in London. We're very lucky in our offices. How are you, James? Haven't seen you for a few weeks. Welcome back. How's everything going?
Yeah, no, very good. Thanks, Rob. Very good. And yeah, Indian summer here in London. The property market also hopefully, well, continuing to experience the Indian summer as well.
Absolutely. And long, hopefully, can it continue for everyone and the wider economy in general. So for those of you who haven't seen the show, it's very simple. You've got the question column on the right-hand side. You write the questions and we give you the answers, any subject, any topic relating to the property, funding, lending, sales, credit, risk, market uncertainty, valuation-based, market activity, hotspots, cold spots, trends, anything, credit, sanction, risk, any of those areas. A lot of the people are in risk, sanction, credit, sales, banking, finance. Please write your questions on the right-hand side. We will give you the answers. Got some handouts today, as always, some good data, sales, and some charts to discuss. As always, we're going to go straight into that. So let's go straight into the intel and data, the 25-week post-lockdown sales intel. That's the first handout on your handout column on the right-hand side. Let's go straight into that and open up the document, because I know a lot of you love going through that because it gives us real numbers, live numbers, what we're seeing on the ground as surveyors, what agents are seeing on the ground as estate agents, what the conveyancers are seeing, transacting, and what in a few months' time will translate into land registry details. But we are live. We're on finger on the pulse. We're telling you what's happening today, now, this minute. So let's go through the data. Let's go through the information. Remember, over the last few weeks on new instructions, I said to everyone, really interested to see what happens first, second week in September. Historically, holiday season, the schools go back, and then we see another rush of new instructions. And that's exactly what we've seen. If you look at the column, new instruction, week 36, 680. That trend, that figure is the third highest of the year to date. And that continues the trend that we've seen since lockdown has been eased and since the stamp duty relaxation holiday period has come in. We've seen an influx of properties coming on the market. And although we saw a couple of weeks in August where that trend slowed down and softened, it seems like from the last week's figures that have been generated, a huge amount of volume coming on stream. And what's interesting is that we've also seen the highest amount of price reductions for the entire year. So yes, it's obvious that the more properties you've got on the market, the more price reductions you're going to see. But what I think we will see in certain hot spots, or should I say certain cold spots, where you've got a lot of demand coming on, basic economics and equilibriums, demand and supply, if the supply of that new stock starts putting pressure on pricing and the price reductions kick in and they then in turn translate to sales, you're going to see in cold spots some price reductions. And that means that pricing will go down by X% in the cold spots. You can't say that trend for the whole country because we're seeing certain hotspots that are overachieving. And the figures we discussed last week, the nationwide numbers had seen the 2 or 3 point growth across the country. So it's not a generic trend that you're going to see cold spots and hot spots where you've got oversupply putting pressure on pricing. It's going to result in a small decrease in completion pricing in certain cold spots. So we really need to watch that trend. The sold numbers are pretty consistent. We're in the mid 150s. And what I like about the mid 150s figure, the 154 on the column of sold, is the exact average mean of sales that we saw in the pre-lockdown 11 weeks. So it's interesting that maybe the pent-up demand numbers have peaked. All the sales now for the 2-3 month lockdown period that were put on hold have now gone through, and maybe, just maybe, we're at some kind of level of sales now around the 150, 160 figure. Or if with the new instructions are coming through, we could see that number go up, and we could see it hit the 160s, 170s, 180s, 190s over the coming weeks. I think it's a really interesting discussion point, and why it's so important to see this data through. I'd like to go back a few months for when lockdown was eased and we saw the numbers starting to come through, and there were some really strong weeks of sales figures and of new instructions. I kept on saying, we've got to see what happens September, October, November, when the furlough scheme ends. If it does end, or it could be extended, we have to wait and see. We want to see, are there legs in the market? Is it sustainable? And the only way we're going to do that is by seeing the week-on-week figures and really focusing on micro data and micro detail to tell you exactly where the market is, so you then can make decisions and react to that. Any questions on that? Please type your question in. We can discuss anything further on this. James, anything on this?
Well, I was just going to add that the uptick, as you mentioned in the new instructions, possibly indicates the seasonal trends, which we see at this time of year, of people putting their house on the market. The children have sort of gone back to school, and the sort of preparation of the sort of autumn surge in the market. So hopefully that additional supply continues to allow the market to flourish.
Absolutely. It's such an interesting market at the moment. And really, I know I keep telling everyone, watch week by week by week. But listen, for those in risk, for those in credit, for those that have got product in the market, you're making live decisions here. And you need to understand, yes, the very short micro of what's happening, along with we're doing 3-year, 5-year, 20-year lens and mortgages. So actually, we'd rather look at the macro and the long term. And I think you've just got to play both. You've got to understand where the nuances are in the market and in lending specifically, because you've got to follow the demand and make sure you got the product that works and align with the demand, where the hot spots are, but where you see cold spots, pricing come in, not so much demand. Then from a risk perspective, that has to then translate to your product and to the risk and the margins that you're then putting into that product to reflect what's happening in the market. So I'm a strong believer in having a macro long-term view with micro changes to follow what the trends are in the market. And I think that perfectly leads us onto the next or the third handout, James, which is the UK borrowing costs for September 2020. I think this is really good data for all of you in risk and credit. It's very resi specific, so it's definitely for mainstream lending. But I do think where you've got other products, okay, and whether you're doing your HMOs or your buy-to-lets or your commercial lend, I think you can understand the trend of where the products are heading to reflect risk and current market trends. So let's have a look at this, James, and maybe talk us through what you've been seeing in other areas on on the mortgage product and the costing piece?
Yeah, so there appears to be a narrowing gap between the 2-year and the 5-year fixed rate mortgages. The Bank of England data, we've got the average 2-year fix currently 1.4%, and that's the average across the market. I know the handout 3 is more split against the LTVs, but just bringing in that extra statistic, we've got the average 5-year fixed at 1.69. We've got a real narrowing gap here between those two products of just 0.29%. This is traditionally sort of up over 0.5%. Is there any reason for that? Do you think this narrowing gap? Or we've got sort of lenders are obviously possibly with this data predicting a longer term period of low interest rates?
Well, I think there's an element of a risk play here. I think just by looking at the July, August numbers and that uptick on borrowing costs says to me that there's a bit of hesitancy within the banks, only a little bit, and they want to build in that extra bit of margin to protect. And I think what's really clear, and I love the chart, and so I hope everyone's got access to this, and if you don't, please write to me directly and direct message me and we'll get it over to you, because the trend really works for all aspects of lending. Why? Because it's LTV and deposit based risk lending decisions. So your margins are based on whatever the gap is, like James was mentioning. So I love the fact that obviously the strongest and best rates are the ones that have the 60% LTV, which predominantly means the largest deposit is being put down, so it's perceived as the lowest risk. So generally that falls into private banking territory, where generally the LTV might be lower than normal because there's a deposit or assets being managed, and so LTVs generally are lower. So it means that the interest rate and the cost is extremely low to reflect the risk involved. At the same time, the fact that there is an uptick there, and this is important for the private banking and also the mainstream retail banking that's listening, there's still an increase in passing on that cost to the marketplace, and that purely for me reflects risk and what possibly could happen in 2021 with the economy and the housing market, and the capability of making repayments and to affect the risk. So I think that's really important. When we move up the scale and we get to our 85s, 90, 95% LTVs, which again can bring us back to how great is your deposit. And then once you're at those levels, you know, the risk appetite is being reduced by the lenders, and also the borrowing cost is going up. And I think there's a big difference there. So anyone that has a non-mainstream lending product and they're at 85, 90, 95%, or even 75 to a degree, if you've got a commercial product or an HMO, buy to let, then suddenly we're seeing an upturn in pricing. So be careful. You know, there's nothing wrong with having the best price in the market, but just be aware that your competitors are now building in a higher pricing. And that's a dramatic change, a 2-month dramatic change, that when you look at the rest of the year and how consistent all of these 60, 75, 85, 90%, 95% LTV cost of borrowing was so flat throughout the year, and only in the last 2 months have we seen the cost go up. I think that's a bit of a red flag. It's a warning sign. I just think for the retail banking, the private banking, the commercial and specialist lenders, I think you should go back, look at your product and say, this is what the market is doing at the moment. And maybe we don't want to either be the best absolute rock bottom pricer in the market, or we need to be building in a bit more risk into our pricing to reflect what the rest of the market is looking at.
Yeah.
I think Sorry, James.
I was just going to add on the 95% LTV, that is going to almost exclusively going to be first-time buyers, and those mortgages probably topping out at 500,000. So that pool is going to be almost exclusively sort of your entry level flats and houses.
Yeah, and also on that point, sorry, James. Also on that point, the lenders that have that product, the 90% and the 95%, are controlling their risk by only allowing a certain amount of applicants to take advantage of the 90 to 95% offer. So that's really important for the lenders listening here. When you hear that other lenders are doing the 90 to 95% product, and you see how much they're pricing it and what the cost is, just be aware that they have the product on the market, but they only allow a certain amount of people to take advantage of that, because they want to control their exposure to the product. And the way to do that is to cap the amount of entrants into the product. So they will allow X amount of people on a monthly basis to take advantage of that rate. When that amount is reached, they turn off the product, or they will not allow the application to go through until they're comfortable from a risk perspective to let more people use the product. It's really important when you see that. You know, some people will be sitting, the lenders and the bankers and the risk people, I cannot believe people are doing 95%. You know, that's scary. But what's the difference at the moment is the way the lenders manage the risk at that price point and that LTV point. It's just by capping and limiting, controlling the amount of lends they do in that space. Go on, James.
Thanks, Rob. Yeah, I mean, the uptick on those 95% LTVs, those are obviously out of kilter with the rest of the LTVs, obviously highlighting the risk in that sector, but also I'm not sure if the products available, like you mentioned, for a 95% mortgage are those sort of new products in light of the market activity and the more sort of positivity we're seeing in the market. Some first-time buyers may be taking advantage of the stamp duty holiday. Do we think that plays a factor there, maybe? And lenders are sort of gearing themselves up to allow the market products for those first-time buyers to be able to sort of enter themselves to the property market and get on the ladder.
Absolutely. And at the same time, it goes back to what we just said before, demand and supply. Pricing can go up when you've got an over demand for a product that has a limited supply. You know, that's where that 95% piece is. A lot of people want it, big demand, limited supply because the lenders have capped it. So pricing can go up because they can get away with charging higher pricing for it. So for those who want to play that risk game, they can charge more money for the product because the demand is so high for that product, because it's the entry point for everyone with small deposits. Let's move on to the next handout 2. And any questions, please send through. We're answering most of your questions within what we're talking about, but anything outside of what we're talking about, please put it in the box and we'll try our best to get through it. Let's move on to the next handout. Recessions in UK and real house prices. I quite like this one. It's handout number 2, I believe, for those watching and listening. And what it does is it tracks the last 70 years of real house prices and GDP. And I think it's really interesting to see that the deepest house price falls in, call it the last 60 years, were the mid 70s, 89, 90, 08, 09, and you know, we're possibly could be entering into one in 2021, or maybe it's a blip like some of the other blips that I've seen when GDP has taken a hit, and it's a half fall rather than the fall, maybe what we've seen 10, 20% declines. Now, everything to do with this at the moment is really, really up in the air. It's definitely market uncertainty for sure. It's also not knowing the second wave of COVID. It's employment numbers, what are they going to look like in 2021, fundamental economics, and the furlough scheme. There are so many variables, but just to get a macro historic perspective of where we could be heading in 21 is super interesting. What are your thoughts on this, James?
Well, I think that obviously the GDP here in the UK, as a result of lockdown, really fell off a cliff, and that's exacerbating the difference here between the GDP and the real house prices. I think, as we show in the graph, there's possibly room for that GDP to be softened if we did have a very strong finish to 2020. So that could sort of smooth the graph somewhat, but we are seeing a bit of an anomaly on historical data, with the residential market performing very strongly. And I'm not sure if that's more of a short-term anomaly, or whether it's coupled with a change in mindset and ethos, and the activity of people sort of maybe gravitating outside of the city centres, or buying second homes, taking advantage of that stamp duty holiday, things that we're sort of yet to see. And it'll be interesting how we finish the year here in 2020 with the house prices and also the GDP, whether they sort of level off somewhat.
Yeah, it is fascinating where the market is poised at the moment. And just to give the listeners and the watchers an update, as I keep on saying, we are the pulse of the market. If we are busy, it's because the market is busy. It's really as simple as that. If we have a busy week, it's just because transactions or refinancing is filtering through, which is why our weekly updates are so important, and the content and the value and the information and the data and the intel that we're giving you, it's just live. We are extremely busy at this moment in time. I repeat, we're extremely busy. It's a perfect reflection of where the market is in certain hotspots and trends, that comes all the way through to us as valuers from the lenders and who are putting money into the market. The areas where that's not performing, we're not seeing as much business. Mainstream commercial obviously isn't trading anywhere near like it was at the beginning of the year. Super prime central London, your Mayfair, Belgravia, etc., isn't trading as well as it historically has, because, and we've explained previously, because a lot of overseas investors, Middle East, Far East, Asian investors, go put their money into that market, and a lot of them aren't even allowed in the country at this moment. So obviously they're slowing down in those areas, but then the donut, what we call it, donut prime, everything outside of that is performing extremely well. Greater London extremely well, the home counties extremely well, and the majority of the rest of the UK. So there is really, really strong performance in the residential market. And I keep repeating because we're just sharing the trends. The HMO market is performing extremely strong. Certain parts of buy-to-let investment market, yes, others not, because rental product, a large supply on the market at the moment. So is all of this sustainable? Where are the trends going to go? Like James has just said, in October, November, December, it's really watch this space. Keep coming back every week and listening, and we're just going to tell you that live data and live information as we see it, hopefully ahead of the game, rather than wait 3 to 6 months to be told something that we already know now. Before we go on to the last question, James, anything you want to add on that?
Yeah, I mean, it's only now that we've got the Her Majesty's Land Registry reporting, I believe nationally it's 2.8% house price growth across England and Wales. more localized to London, I think we're at 3.16% market growth from the section May 2020 to June, July 2020, all of which at that time we were reporting to you the positivity in the market, the volume of instructions and how busy we were just on the front line, and bringing that data live.
Yeah, I mean, you know, to close out for this week, the market is poised. It's a fascinating time to be lending, risk, sales, hotspots, cold spots, trends, both positive and negative. Looking at the GDP data and historic trends, will the market fall off a cliff next year with the economy and unemployment and furlough? Is the market robust and strong and sustainable? And will the positivity and the volume of transaction carry on as we're seeing at this moment? And that's what keeps us coming back every week. That's why there's so much live information to allow us to give a weekly update and report to the marketplace, because something's changing every week. New information is coming through every week, new data, new intel. And it's just going to be fascinating the next few months. And for everyone's sake, we hope that it's positive and it's good, and we get over the second wave, and there's more money going into all of the markets, both commercial and residential, and we see an upturn in 2021. And if not, we then have to share what's strong, what's weak, where to stay away from, how to reflect your risk models and your lending models like we're doing today, and move it forward. So anyone that needs further, more in-depth questions answered, please obviously contact us directly. But we'll keep giving you the data, giving you the intel, giving you the numbers. Anything we're not doing, let us know. We will be back same time next week, 1 o'clock every Wednesday, #AskRobCo. Thanks, James. Follow us on all the platforms. Share all of your views, feedback, and opinion, and we will share with you all of the data, intel, and market knowledge that we have, so that you can make your decisions on a daily basis. And we are here to continue and help and support you through the COVID crisis. Thanks, everyone. Really appreciate your support. Super grateful for all of you that come back every week and all of the amazing feedback. I'm really, really touched by all of your feedback. Every message, every email that comes through, I personally read. All of you that are writing to me and saying thanks. Try my best to get there every week. Love the content, love the intel. Share it with my team, share it with my board, share it with our risk teams, our sales teams, our sanction teams, our credit teams. I really, really, really appreciate it, because just doing it for you, that's why we are here every week. And as long as you give the feedback, we will give you the content. Great. Enjoy the Indian summer, and we will see you all same time, same place next week. Have a great week, everyone. Take care.
Thanks, everyone.